Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending July 1st, 2022. Hope everyone's getting ready for a nice fun holiday weekend. And a reminder to subscribe to this video as well as our podcast InvestTalk. Now, I'm going to title this week's video Recessionary Readings Bring Potential Market Inflection. I know it's a little long, but it kind of encompasses what you saw this week. There was a lot of economic news that really reflected what's going on in the economy for the month of June, and I want to start. I always want to start with like the most up-to-date readings, which are the PMIs. So this is the ISM manufacturing PMI that came in at 53. That's the lowest level we've seen since June of last year. And the new orders index, that came out in at 49.2, which anything below 50 is shrinkage. So new orders are definitely falling in the manufacturing sector across the economy. Now, the Richmond Fed Manufacturing Index, that also went into negative territory to minus 11. Chicago PMI decelerated to 56, the lowest level since, August of last year? August of 2020. And so all of these figures are showing that we're in a more recessionary environment right now, because these are reflective of June. Now, pending home sales, that was May. That did tick up just slightly month over month. But, if you look at the overall more up-to-date indicators, the coincidental indicators, you're seeing a sharp deceleration in the economy. The ISM Manufacturing Prices Paid Index, that also decelerated to 78.5, and then U.S. Core PCE Price Index. So stripping out food and energy, that also decelerated for the third month in a row. So it just shows you the inflationary pressures are abating. Now, the question is at what pace? And remember, this is May. So commodity prices didn't really fall until June. And so certainly this is going to decelerate again. The question is to what degree? So all of this brings a backdrop on policy, Fed policy, that is likely to mean some sort of pivots probably by the end of the summer. Now, to what degree that pivot is just a moderation in the pace of tightening. We'll see, right? They're still pricing in a high likelihood of 75 basis points in the month of July, end of this month, in Fed meeting. But then they don't meet until September. They also have Jackson Hole meeting between the next Fed meeting and the September meeting. And that oftentimes is a place where they kind of update policy, talk with all the central bankers throughout the world, and kind of make a shift. And if you continue to see these economic figures for the next basically 2 months into that meeting, there's likely going to be a pivot. And it's not just what I'm prognosticating, it's now what the market is pricing in. The Fed funds futures are now pricing in a Fed rate cut. Yes, a rate cut at the beginning of next year. So the first quarter of next year. So don't be shocked to see if that's the case. Remember, not just a moderation of tightening, but actual reversing of policy by the first quarter of next year. So that's very, very interesting. And so if you do get a rally, and we are in a recession right now, everyone's saying, are we in a recession? Are we in a recession? Being in a recession is actually probably the best case scenario right now, because that's when typically markets bottom, because that brings an inflection in Fed policy. The Fed has hiked rates very quick, very fast, faster than almost any time in history, and that's brought a large deceleration in asset prices. So if they do pivot, well, that could mean a relief rally, short covering rally, etc. And I think that's what you're likely to see in the near term. We talked about that break. This is NYSE, that major 382 retrace on the weekly. It held that last week and held it again this week, although it was a modest down week overall. It still held above that break up candle low, which was right here around 14,400. on the NYSE, and it tested that twice and reversed. And so this is looking a bit constructive, at least in the near term. I also want to look at the ratio between the small caps and the SPY. That's starting to gain a little bit of traction, trying to consolidate at this 100-day moving average for a potential rally. And usually the small caps will lead. So I'm looking for a breakout there in the next week or two to kind of confirm that the relief rally is on. Now here's the S&P overall. You had the 2.5 retrace and the 20-day moving average as resistance. You got a 3-day pullback here, Tuesday through Thursday, and a nice little rally today. But overall, something that looks relatively constructive. We can hold that low from yesterday. And what's most instructive about what's happening in the market is our interest rates. So the 10-year has now come from a high of nearly 3.5. We closed today at 3.89. So you're talking about 60 basis point drop in the span of 2.5 weeks, and that is a shift in policy. Here's the SHY, or the shift in expected policy, and you're seeing that rally here. And you were kind of getting that with the MACD. You see this higher low divergence was saying that maybe this breakdown in the short-term rates was a bit overblown, and something that I was definitely paying attention to. Now the dollar, that hasn't failed to really break out. It's really just been, it's still in the uptrend, but you can see the momentum waning. And here's the opposite happening, where you're seeing a divergent high on the dollar. And if there is an inflection point, the dollar is going to start to weaken. And so that's something to watch. And then here's the yen. The yen is also getting a bit of strength. Nothing substantial, but you're getting that MACD divergence once again. So something I'm watching. And this is just would be the Fed pivoting and putting less pressure on the Bank of Japan to also raise rates. Okay, so that's what you're seeing there. Now gold attempted to break down and failed today so far, but the big reversal was actually in the GDX. So that was I think this is a fake out breakdown. It's hitting this through this 618 retrace from this entire move. It never hit that, right? The breakout from COVID, it never hit that. Finally hit that this week and has held it. Something I'm definitely watching next week to see if there's a relief rally on that potential inflection point. Energy, that was an interesting, after this recent pullback, you're starting to see a little bit of a higher low here and the potential for this to resume its uptrend, something I'm watching. Overall, I expect energy probably to be more in a consolidation phase as opposed to a breakout if the economy is slowing, but something to be on watch for, at least a relief rally in the energy space. Another indicator that the market is pricing in lower interest rates are things like consumer staples. That's rallying. That's also probably getting a little bit of tailwind from inflation moderating as well. And then you have the utility sector that is just having a massive rebound, almost recaptured all of its losses after that kind of breakdown of expected breakout in rates, and that certainly was a head fake on the rate sector. And now you're getting a rebound in utilities, and same with REITs. REITs are rate sensitive, and you're starting to get a lot of traction there. That's a nice, much better, higher high on that. You can just look at the IYR to the SPY getting a breakout to the upside. So certainly liking those sectors that are going to get tailwinds from lower interest rates, which would be, once again, real estate, utilities, consumer staples, gold, precious metals, etc. So that's kind of what I'm expecting. I'm expecting a relief. Actually, I want to get to the VIX lastly. Another indicator that we could potentially seeing a relief rally is, look at these lower highs on the volatility. Remember, upwardly trending volatility is bad for markets. You want to see lower lows, lower highs in the volatility index, in the VIX, in order to get an indication of where we are going for the market. If it stays low, going lower, that means a healthier, more positive stance in the equity markets. So something I'm on watch for is to see if this level breaks around 24 and the 200-day moving average on the VIX. And if that's the case, that could mean be an indicator that we're going into a lower volatility environment, which means just a general float higher in equities overall. So that's where we're at. And there's a lot of negative sentiment out there, but the bond market's usually smarter. And like I said, the bond market is starting to price in the Fed being near the end of its rate hiking cycle, or at least its rate hiking rhetoric, because of the backdrop of the economy. And they don't want to create a giant mess. They just want to slow inflation, and you're starting to get a lot of those indicators. So I think that's about it. I want to wish you all a wonderful holiday weekend. Everyone stay safe out there. And a reminder that the contents of this video are provided for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial and those associated. I thank you all, and you have a wonderful weekend.